I want you instead to get all the data and be able to manage your own money in a SIP, pension, or investment account and have all the data, and we give you the data and we do all the hard work. But we don't have a conflict of interest with you because you keep hold of yours with whichever broker you use, Barclays, Hargreaves Lansdown, Freetrade, whoever. And we give you all the data so you can understand, as we put it, cognition, i.e. brains, over commission. Don't charge commissions and fees and subscription fees. Whatever you do, you must make sure any company you have ticks the valuation box, the growth box, and the income. You want companies here in the middle. Don't ever buy into a fund, which is a value fund or a growth fund or an income fund, because what they are or don't ever buy into a geographically restricted fund, because what they're actually saying to you is we're going to pick from a very narrow gene pool. Okay, we're going to pick from a very narrow gene pool. Don't do that. And I'm going to tell you what happens if you don't listen to what I say, because my secretary worked for me for 2 years, went into the retail side of things, didn't follow what I showed, and has ended up getting really bad performance as a result. And I'll show you that in a second. Okay, and I'll show you a real life example of what happens if you don't bloody follow what I say. Make sure you have the high standards. It has to be undervalued, has to be growing, has to be producing dividend yields, has to show momentum, i.e. positive returns. And if you're going to pick anything statistically, please pick Sortino's. Okay, high average return versus low downside risk. Now, I've told you about mummy, baby, and daddy bears. Okay, 1 is a daddy bear, 2 is a mummy bear, 3 is a baby bear. Baby bears can be ignored. Mummy bears, if you're risk averse, you can start taking some money off the table. Daddy bear, you may well take all of it unless you're very risk loving, in which case you'll sit through it. If you're risk averse slightly, you might, as I am, I'm slightly more risk averse than most people, because my job at my age is not to F it up. Okay, as Michael Bloomberg famously once said when he became mayor of New York, he said his job is not to F it up. Now, this was a previous year. This was 2020 to 2021. Why that year am I showing you? Because that was a mediocre year. 2023 has been spectacular for the stock market, so is 2024. I can show you the results of that, but they're probably very uncharacteristic. 2020 to 2021, which included that post-COVID period, is somewhat uncharacteristic and somewhat normal. Somewhat characteristic and normal. Okay, now, why did we not get a 208% return? Because we're not good enough to know how much a stock's going to go up. We just know that ticks our boxes and should do well. If we're good enough to know how much it's going to go up, we've only put our money in that one company, wouldn't we? That's why we didn't get 208%.